Thank you. I first want to emphasize the importance of simplicity. That is a word I use all the time. Welcome, take a seat, get comfortable. So this is about simplicity. So I've got bullet points I'm going to be sharing. I'm going to read them, and then I'm going to break them down in simplicity. What I think is important is to take notes. As I go through things, something's going to come up for you. Whether it's a highlight of a bullet point where, ooh, that's a good thing to know, and then you write it down. If something pops up and there's a question, write it down. That way you can remember it. And what we're going to do is we're going to have this. We have to make sure that we leave here at 6:50. So they're shutting it down at 7. I'm expecting this to go for about 45 minutes or so, which is then going to give us the opportunity for questions. And I encourage the questions because a good question, in my perspective, is one that you don't have the answer to. And the question that you ask is likely a question that someone else might want to hear or didn't think of that's also important to them. So this is really important. You have 2 pieces of paper. One is for taking notes, and the other is a form that at the end of this, you're welcome to fill out, put in your information, and I will call you and have a complimentary consult with you with the intention of just giving you clarity. And it's important to note, in my experience of being in life, right, for 51 years, is that a lot of stress and anxiety about anything comes from not knowing what to expect and not having clarity. And so when we get clarity on something, it might not be the answers that we want, but at least now we have a path forward. And now we have clarity, and so the stress or anxiety decreases. So I can't control all the stuff you go through behind the scenes in your mind and body and relationships and all the things that we all go through. But when it comes to the money wellness part of your life, is what I call it, and when it involves real estate and home ownership, this is where I can come in and help make your experience easeful and peaceful. Okay, does all that make sense? And does anyone have any questions before we begin? Okay, all right, so we're going to get started. You have a clicker for me?
I believe so.
Okay, uh-oh.
Tech manager left.
Okay.
I'm sorry.
Yeah,
Switch.
No, this actually is getting plugged in.
Yeah.
Oh, that's okay, that's okay. Thank you.
Are you putting the spring too? Either one.
Oh, it goes in the, here, let's see. Oh, let's see. There we go. Okay, are we good? All right. So my background is this August, I'm in this business for 27 years. And the first several years, it was, a young guy trying to make a living. And then I was part of this mortgage market meltdown that happened back in 2008 when everyone lost everything. And I was one of them. And so several years, it was very rough, and it was part of my journey because it inspired me to become really knowledgeable and help people who are in really, really tough times. And when the market shifted again, I was back in action, and here we are in 2026, and I'm still doing it. And before, where it was a way to make a living, now it's an opportunity to be able to connect with people and be able to give ideas and ways of utilizing, again, what I call money wellness. So this stuff becomes a little bit easier. And then some of the things that I share, you can actually apply into different areas of your life. Okay. So on today's agenda, can you guys see okay? Here, actually, maybe I'll come over here. Is that good? Okay, good. So today's agenda, these are what we're going to be speaking about. Today's housing market, understanding interest rates, closing costs and cash to close, down payment strategies, credit preparation, mortgage program options, understanding refinancing. How many homeowners are in here right now? Okay, 1, 2. Okay, gotcha. Okay, so everyone else doesn't own a home and is interested in buying a home. Is that fair to say? Okay, great. The home buying process, what that looks like, the pre-approval process, common mistakes to avoid, building long-term wealth. How really you always hear about people getting wealthy off of real estate, and it starts with your first purchase. So let's get into today's housing market, understanding where we are and what it means for you right now. So home prices and inventory levels have shifted significantly. So whether you're buying or you already own, understanding today's market tells you if the timing is right to act. So several years ago, when the pandemic hit, rates went down significantly because everyone was bugging out. And the government said, let's lower interest rates so everyone stops bugging out and they want to go buy a house because it's what stimulates the economy. And because of the demand, because rates went down, everyone jumped into the market. There were 4 or 5 people trying to buy the same house, which then raises the price. That's how values go up. It's the supply and demand. And so right now, Florida is one of those states that has a steady increase in value over time versus most other states in the country, because people love to be in the warm weather and the beach. And that's why it's tough and it's expensive to live in South Florida, because of the supply and demand. Values go up. As a result, taxes go up, and then insurance goes up because we're in a hurricane state, and all of these different things. So, but the benefit of buying in Florida is, even though you might be getting into it now, in 4 or 5 years, it's like, hey, I'm glad I got into it 4 or 5 years ago. The Federal Reserve's rate decisions directly impact mortgage rates, home affordability, and the value of the equity you've already built. So we just touched on that. So when the Federal Reserve, when you hear the rates dropped, it's not mortgage rates that's dropped. It's rates that commercial banks use when they lend out money to businesses. And then eventually it leads to mortgage interest rates. So if the Federal Reserve drops the rates, it's likely mortgage interest rates are going to follow. But again, it goes back to this. A lot of people sit on the fence and they wait for rates to go down, not even realizing what that even means. It's just, oh, the rates are down. But what happens is everyone says the rates are down. Let's go shopping. Let's go get a house. And then again, you've got 3 or 4 people shopping for the same house, and it pushes the values up, because now the seller's like, well, I've got 5 people who want to buy this house. I can charge a little bit more, and that increases the value. Which is why the federal interest rate dropping is not necessarily a good thing when you're buying. But it can be a good thing if you're buying when the rate's a little bit higher and you buy the property at a lower value. When the rates drop, you refinance to a lower interest rate, having bought the value that's a little bit lower. So now you've got a home that's gone up in value and you've refinanced to a lower interest rate. Low inventory continues to support home values, and the good news for owners, building equity, and an important factor for buyers to understand before making an offer. So we just talked about this, low inventory in Florida especially. So someone says to me, I've got a budget of $1,500. That's tough in South Florida to have a mortgage, unless you're maybe over 55 communities, because those properties are still at a reasonable purchasing power. But $1,500, and you can write this down. Your budget, that you think about your budget, is about 1% of the loan amount you're going to qualify for. Yeah. Your budget, what you're comfortable with and paying on a monthly basis for your mortgage payment, is about 1% of what your mortgage balance is going to be. Example, if your affordability is $2,000 a month, that is 1% of $200,000. So then your mortgage balance is going to be about $200,000 with a mortgage payment, taxes, insurance, etc., of $2,000. That's a basic general rule of thumb. Now, actually, it might be about $1,700 or $1,800, but it gives you an idea of what that looks like. You want to buy a $500,000 house? Then you're probably going to have a $5,000 payment, maybe $4,500. You want a $1,500 payment? Your mortgage is probably going to be about $150 to $175. Same thing with your purchasing power. Okay, makes sense? So 1% of the total mortgage is roughly going to be what your mortgage payment is, which when you start to figure out what your budget is, what your maximum budget is, and that's what I always share with people, what is the most that you're comfortable with being able to afford on a monthly basis before it becomes uncomfortable. Now you have your budget. And then we go in reverse to figure out what that's going to look like. Okay? And when I say monthly payment, I'm talking about what would be equal to rent. You're paying the mortgage company, which is your principal and interest and taxes and insurance. It's equal to a rent payment, not electric bill, not water bill. Rent and mortgage, similar in energy. Regardless of where rates are today, real estate remains one of the most reliable long-term wealth building tools available to everyday Americans. So if you bought a house before the pandemic hit, you tripled. It tripled. A $100,000 house in 2018 was worth $300,000 several months after the pandemic hit. And people that sold walked away with $200,000. Right? Some people leveraged, meaning that they took out mortgages to go create more wealth. And some people just sat tight. And then the market was inflated, and then they came down a little bit, and now they're stabilized. Except in Florida, they continue to gradually go up just a little bit, which is what we want. We don't want this spike. You know, if you own a home and then it spikes, great. But here's something else to consider. Equity in the home. Equity is the difference between the value and how much you owe. That's equity. Equity doesn't mean anything unless you're buying or selling. So if you bought a $100,000 house and it's worth $300,000, you have $200,000 in equity. Great. But if you're not selling it or you're not doing anything with it, it doesn't really make too much of a difference. But it's good to know that if you have to sell it, you can walk away with the equity. Understanding interest rates. How rates are set, what moves them, and how they affect your payment or equity. So your mortgage rate is determined by a combination of market conditions, your credit profile, loan type, and how much equity or down payment you bring to the table. So some people will call me and they'll say, hey, Jay, what's your interest rate? And that's similar to calling and say, hey, going into a car dealership and saying, I want to buy a car, how much is it? There's a lot of factors that go into what the cost of a car is, just like there's factors that go into what determines your interest rate. So write this down. There's an acronym called DICE, D-I-C-E. D stands for debt. How much debt do you have now with your credit cards, car payments, etc., as well as what your mortgage payment's going to be? That's your debt. I is income. How much income are you bringing in? Your W-2 income. Or if you're 1099, or is anyone in here self-employed? Okay, no one's self-employed. Okay. If you've ever thinking about starting your own business, which I'm sure all of us had thought at some point about starting our own business, you can get mortgages without using tax returns or W-2s. Okay, so keep that in mind. I is income. C is credit score / credit history. Right? Do you have collections? Are your credit balances maxed out? Are they not? What's the actual credit score? Are you in the 700s? Are you in the 500s? And by the way, anyone who has a credit score starting with the number 5, it means that there are unresolved collections and they need to be resolved. And you don't have to pay a credit repair company. You just have to talk to someone who knows what they're doing when it comes to raising the credit score. If you have 650, why don't you have 750? You need to have an understanding as to what you can do with your credit to be able to increase it. The higher the credit score, the lower the interest rate, the lower your payment's going to be, or the more purchasing power you can afford, simply because of your credit score. Now, I can do a loan for someone who's got a 500 credit score, just for the record. So if you or anyone you know has a 500 plus credit score, I can help. However, I always want to look at that credit report to see what we can do to raise the score so we can get a lower interest rate or less money out of pocket, so it becomes more affordable. A $1,500 payment with someone who has a 650 credit score is going to get, let's say, a 175 house. If that same person at a $1,500 payment has a higher credit score, they can get a $200,000 house. It changes simply based on credit score. It's important. E is equity. E in DICE is equity. Equity is, if you're buying, what's your down payment? And if you're refinancing, how much equity is in the property? All these things is what determines what the rate's going to be. And so you're in control of some of this. What you're not in control of is market conditions. We're in this war with Iran, right? Oil prices are up. People panic, except for the ones who own oil, right? People panic. And so the Federal Reserve says, okay, let's calm everything down. And we know gas prices are high and eggs are costing more and all these things. Let's drop the interest rates. So you guys want to go refinance and maybe consolidate credit, or you're inspired to go buy because the rates are lower, okay? But market conditions. But this is how interest rates are determined. For buyers, even a 0.5% difference can mean hundreds of dollars per month or thousands of dollars a year, right? And this is what we just talked about. If your credit score is 700 versus 620, the difference could be 0.5%, which could be $3,000 to $4,000 a year in going to the bank or staying in your pocket. And you can imagine if you keep $3,000 a year in your pocket versus giving it to the mortgage company, that's where you can start to put that in like a retirement account. I mean, most of us are going to probably go to dinner and take a little vacation, that sort of thing. But if you can discipline yourself to say, hey, I've got good credit, I'm putting money away. Now you've got a piece of real estate that's going up in value, and you've got this financial instrument over here, whatever that is, that's also growing in value. And this is how wealth creation starts. And if you can put $3,000 a year in this over here, because your credit score is a little bit better, because you took the time to understand it and take action to make it higher, you can see how powerful this can be in the long term. It's like anything that requires work that you're doing, that it has a long-term benefit, just little steps here and there, it builds up. Oh, see? To the truth. Oh, okay. For homeowners, today's rate environment determines, what's that? Right. Hey. Oh, hey. Oh, okay. I don't. Okay, show of hands. You want it on or off?
We all gotta stay still.
Off. Okay, so might as well turn it off so it doesn't flicker and cause distraction, maybe. Yeah. And these seats are I haven't seen seats like this in a space like this. It's comfortable. It's getting dark. It's like, just stay with me here. We don't have pillows. Stay with me. Okay. How many people showed up here today after work? Right. So you've already used all that mind energy. So I'm hoping this can be valuable for you. So I'm going to see what I can do to keep you in. I might just do jumping jacks in about 10 minutes. So just to kind of keep the energy flow. Okay. So for homeowners, today's rate environment determines whether a refinance makes financial sense, and the math is simpler than most people think. So when you do own a home and you're thinking about refinancing, here's how to determine if it makes sense. Same thing with purchasing. I'm actually including purchasing in this. With anything. This goes outside of mortgage lending. It makes sense if you're clear on what your intention is. And does doing something satisfy the intention? So if you're going to purchase a home and you have an intention of buying a home and you've got your budget and you've got your money here, does it make sense? Maybe it does, maybe it doesn't. The rate becomes less important than the intention. I talk to people, I'm not going to make a move until the rates drop down to here. Oh, how much credit card debt do you have? 50,000. What are your interest rates? Well, they average about 25%. Okay. So Someone's paying 25 to 30% interest on credit cards, and they're not doing anything with their mortgage. And so I can come in and say, well, let's look at the math. If your intention is to lower your rate to save money, it's managing what you owe. So if you can combine this and save $1,000 a month, does that satisfy your intention? But this is applied to all areas in life. What is your intention? And does this plan satisfy the intention, yes or no? Fixed versus adjustable rate mortgages serve different goals. A fixed rate offers predictability, while an ARM, adjustable rate mortgage, can make sense for a shorter term plan. So essentially, someone's going to do an adjustable rate mortgage if there's a plan to live in that property for just a few years because they know they're going to be selling it or moving on. And sometimes an adjustable rate is going to be lower than a 30-year fixed or a fixed rate. And so if the rate's lower, your payment's going to be lower. Okay? So that's why you would do an adjustable. Most people, I'm more of a conservative guy. I always encourage to do a 30-year fix because it's not that much of a difference. And why risk it? If it makes a significant difference, if it's $300 to $400 a month and the math makes sense, well, you have an intention. Does it satisfy the intention? But that's the difference between a fixed rate and an adjustable. Usually an adjustable is usually for real estate investors. And sometimes real estate investors are buying their primary residence with the intention of turning it into an investment property, which could be any of you that are sitting here. Almost every one of you are here looking to buy a home. And if you're looking to buy a home, then it's reasonable to assume that at some point you're going to go buy a different home and you can use your next home as a rental. Now you've got two homes, one that you're going to buy and one that you lived in for a couple of years and now you're renting it out as it's going up in value. And people just keep doing that. And every 2, 3, 4, 5 years they do that. And before you know it, there's 4 or 5 homes. And now they're worth $1 million as an example. And it's very doable if you stick to that plan. Closing costs and cash to close. What you need at the table and the strategies to reduce it. Okay, so closing costs. Closing costs are going to typically range between 3 and 5% of the purchase price. Okay? 3 to 5% of the purchase price. So right away, when you're looking for something, if you're looking for a house online and you see what the purchase price is, multiply it by 5%. That's going to be roughly your closing cost. Likely they'll be lower, but I'm an advocate of psychologically going into the worst case scenario. If it turns out to be 3.5% or 4%, great. It's less than what we guessed, but figure 5% of the purchase price. Now, if someone's coming to the table and they're putting down 20%, which is not needed, I'm going to get into the down payment requirements, then the loans are going to be smaller and then the closing costs will be less than 5% of the purchase price. But this gives you a gauge, 5%. Down payment assistance programs, which DPA, are available for eligible buyers and can cover part or all of your required funds to close. Many people qualify and don't know it, okay? So I'll use an example. If, and we're going to get into the different products, but let's say you have to come up with 3.5% down. And I'll just use simple math just to keep it simple. But let's say you're buying a $100,000 property and you need 3.5% down, which is $3,500. Maybe you don't have it, or you have it, but if you spend it, it wipes you out. Down payment assistance will give typically 5%. And you can use 3.5% for the down payment and then 1.5% for closing costs. And then you got to come up with the other little bit to get to that 5% mark. So typically speaking, you want to cover on your first purchase, especially because of this crew, everyone said they're pretty much it's going to be their first home. 10%, you can write this down, 10% of the purchase price is going to cover your down payment and closing costs. 10% of the purchase price is going to cover your down payment plus closing cost. And it's most likely going to be less than that. Again, we're just being conservative. And so one of the ways to absorb an example, $200,000 purchase, 10% is $20,000. Okay? Now, if all of a sudden you get the closing cost and some of that covered of 5%, you just go from needing $20,000 to $10,000, just like that, because you qualify for the DPA, the Down Payment Assistance Program. And there's a couple down payment assistance program. One is a grant you don't have to pay back, except when you sell or refinance. Another is a loan where you're being charged for it. It just depends on what you qualify for, what your situation is. But it's really helpful. Yes.
Is that usually just for new home buyers?
Well, good question. Is it typically for new home buyers? The answer is yes, number one. But number two, a new home buyer is someone who has not purchased a home in 3 years. That's a home buyer, new home buyer. So if you purchased 5 properties and it's been 3 years, you're considered a new home buyer. Okay. So that's down payment assistance. Seller concessions allow the seller to contribute toward your closing cost, effectively reducing what you bring to the table. So check this out. If you get DPA of 5%, remember you need 10% in this scenario we're talking about. You get the DPA of 5%. Okay, that's, let's say, covers your down payment of 5%. The seller of the house you're buying can contribute up to 6% of the sales price to pay for your closing costs. So if a seller is buying a property for if a seller is selling a property for $200,000 and you're negotiating, right? It's like, no, I'll give you $190, right? The negotiation. And they say, okay, I agree to $190. Okay. Then you go back and say, all right, I'm going to give you $200,000 and I want you to give me back $10,000 at closing. Now, they just agreed to take a $10,000 hit. But instead of dropping the price from $200 to $190, they're putting in the contract that I'll give you the $10,000 instead of having the contract at $10,000 less. So it's a way to absorb the 10% that we just talked about, right? The seller is going to give you $10,000 at closing. Yes. Now, not all the time, right? It depends on how long the property's been on the market. If a property is in the market, if you look at Zillow or whatever, and you see a property in the market for 10 days, no, they're not, most likely not going to do that in Florida. Very unlikely. But if it's been on the market for 30 or 60 days, maybe they're a little bit more desperate. And that's when you can go in and say, hey, I need you to pay for my closing costs. Now you got 10%, you got $20,000 covered, DPA, seller concession, you're getting into a property zero money down. That's one of the ways to do it.
So they still say they sold that house at $200,000?
They would still have sold the house at 200. That's what county record's going to show. But
Why they want to do that? To be able to show that I still bought it for this, but I helped them out to get rid of it.
Well, if you're buying, yes, because again, they're now in a place where they're agreeing to take that $10,000 they're giving you would otherwise be in their pocket, and they want to sell it. So they're willing to give you $10,000 of their profit in order to help you close. And I get that all the time. And so, yes, the record's going to show you paid $200,000. The contract's going to show you paid $200,000. But it's just massaging the paperwork. Everyone's on board. The seller still gets what they want, which they agreed to $190. They're just putting in the paperwork $200, and then you get to move in with zero money out of your pocket. Oops. And you know what? And there was one other thing that so let's talk about the lender credits. Okay, lender credits and gift funds from a family member are 2 additional tools that can significantly reduce your out-of-pocket cash to close. Lender credits and gift funds. Gift funds is you ask a relative to give you money as a gift to help. I need 10 grand. Parent. It's essentially, the rule of thumb is blood related, but there's no family mortgage police. Someone's going to sign a document that says, I am the aunt, I am the uncle, I am the mom, I'm the dad, and I'm gifting this person $10,000. Okay. Now, you didn't hear this from me, but what you do outside of closing is up to you and your journey. But the family member is going to gift the money, and they're writing a letter stating, I am gifting this person this money. That's another way to absorb that 10%. Another way to absorb the 10% is a lender credit. That means I'm giving you money. I'm giving you potentially thousands of dollars. How do I do that? Because we're going to raise the interest rate. So you might say, Jay, I need the lowest interest rate so I have the lowest payment. And then I say, okay, well then I can't give you back a credit. You might say, Jay, I want $5,000 to help me with my closing costs because the seller only gave me $5,000 and I need another $5,000. And I say, okay, we're going to raise the interest rate and I'm going to give you a credit that way. So look at all these different ways. And by the way, you just saw all these different ways to absorbing the 10% that you need to close. And it could be a hybrid of any of those, a hybrid. And then one other thing that most advanced home buyers and homeowners don't know is that, especially everyone here is W-2. If you have a 401k, the 401k will let you access your 401k money one of two ways, either in cash or a line of credit. They will give you a loan against your 401k because you're using it to buy your primary residence specifically. There are rules, but you can go up to 50% of the value. So if you need 20 grand and you have a 401k that's 40 grand, you got 20 grand. And your 401k is not doing so, you're not becoming a millionaire off your 401k. The government says, we're going to hold on to this. That's our rule. And then you're like, yeah, I got a little nest egg here. But not necessarily. It's building slowly. So if you need it because you want to buy a house, now you have the ability to access it. Make sense?
What about life insurance?
Life insurance is speaking to the question is, can you use life insurance as a way to cover some of the cash you need to close? And the answer is you have to speak to whoever manages your life insurance policy and you ask, hey, I want to take some money to use it for my down payment and closing costs for the purchase. Do I have that option? Okay. And that's with, by the way, that's with any investment any of you have or will have. You can typically leverage, you can usually borrow against that instrument. And I just shared with you how to do it with a 401k. How are we doing with timing, Tiffany? Okay. All right. What time is it? 6:15? Okay. Oh, wow. Okay. I'm probably gonna have to speed this up. Okay. So I'm gonna punch out a lot of these bullet points. And then it'll be good because you'll be able to write down some questions. Okay. 20% down payment is a myth. You can get away with zero money down. I just shared with you how to do that. Any veterans in here? Okay. Anyone you know who's a veteran, zero money down. If you buy, you're a veteran?
No, I have a family member that is.
What's that?
I have a family member that is.
Okay, gotcha. Zero money down. USDA means that the property is in a rural neighborhood, means it's like 20 minutes from like a big grocery store as an example. If it's rural, USDA, zero money down. FHA is, let's see what this was. Okay. Oh, this was from the other part. So, what's that? So FHA is a government product that allows you to put down 3.5% down and you can have rough credit in the 500s. It's a government sponsored product that lets you get into real estate buying even though you don't have a lot of money and the credit's not the greatest. And the interest rates are still low, but it requires 3.5% down. And the DPA programs we just talked about, you can use that to apply toward the 3.5% that you need. Okay. How to get the money that you know that you'll need. We talked about the down payment can be very little, 3.5% or 5% down. It's not 20% down like most people think. Down payment assistance programs, grants, forgivable second mortgages. That's the down payment assistance program. We talked about gift funds and then 401k and leveraging retirement money. And then the lender credit. And then here's another thing. If someone's going to help, then maybe the person who's going to be gifting you can actually do what's called a home equity line of credit against their current home to be able to access money to be able to give it to you. Or when you own a home, you'll be able to do a home equity line of credit. It's a giant credit card tied to your house. That's what a HELOC is when you hear that term. Okay, credit preparation. I'm just going to put all these up here and go through them pretty quickly. Your credit score is one of the single biggest factors in determining your interest rate. A 40-point difference can cost you thousands of dollars over the life of the loan. We talked about that. For buyers, the 90 days before applying are critical. Avoid new accounts, large purchases, or co-signing that could shift your credit score or raise your debt to income ratio. If you are going to be in the market to buy a house, protect your credit. How do you do that? Don't open up new accounts. Don't co-sign. Don't do anything that involves using your social security number, is a simple way of looking at it. Okay? Because when you pull credit, a hard credit pull, your score can drop. If you open up a new account, your score can drop. If you open up a new account, we now have to add that as debt. And now we are increasing your debt, which might cost you on what you can afford on a mortgage. 90 days before you think you want to move forward, don't touch your credit. Or we pull your credit to see what we can do to make it nice and clean and healthy. So you're optimal when the time comes. Yeah.
Do you define kind of large purchases against your income or against the loan?
Large purchases that involve using your credit. Okay? Like if you're going to go buy a large purchase, might be a refrigerator at BrandsMart, and you're taking out a credit card to do that. Okay? Or another part of large purchase is if you've got money allocated for your down payment and closing costs, and you have cash, and you go buy a refrigerator or an appliance, whatever it is, you just used up some of the money you need to close. It's really, really important that if you're going to move money, you're going to spend money, you have to speak to the person who's setting you up with the mortgage. Okay? And then for homeowners considering refinance, pulling your credit now and identifying any errors. This is not only for refinancing, this is for purchase. We pull credit now. One of the things that I encourage people to do is pull your own credit. Go to one of these services, Credit Karma, the bureaus, whatever it is you use, pull your own credit, produce a full credit report, pay $30, write that down, pay the $30 to $35, get a premium credit report. It's considered a soft pull. It's not going to affect your credit. And then you can send it to me and I'll assess it. And I'll let you know what you can do to make it nice and healthy, if there's anything. If you've got an 800 credit score, you're in good shape. If you're less than 700, there are things that you could do. Maybe not, but at least you need to be aware. Yeah.
Credit Karma allows you to pull your credit once a year or something like that?
Yeah, that's what I'm saying. It's a free service. It doesn't really help me much. What helps me is pay the $30. They offer a premium service. It's like $30, $35. You're getting what's called a tri-merge. It's 3 credit bureaus, and it's going to give me everything that I need, which avoids me having to do a hard credit report, which costs me close to $100, and you might be 6 months off. So it's the way where we can balance each other and do a good energy exchange.
If I have an 800 credit score about, so do I still need to do the soft?
No. After that, I'm just trusting that your credit score is that high. But however, you want to be aware of what your debt is, because we want to be clear on your debt to income ratio. It's a different conversation. Okay. Rapid rescore strategies. Rapid rescore is, let's say you need a 640 to qualify for next tier of interest rate. And the only thing that's keeping your credit score below 640 is you have a credit card balance that is at 90%, right? $1,000 credit card, you owe $900. You're at a 90% ratio with your debt. If you pay that $900 down to $300 as an example, your score can shoot up 15 points. Understanding your credit card balances and making sure they're low can significantly increase your credit. There are several things that we can do that by looking at your credit report, if we need to move fast, we could do a rapid rescore in 10 days if something is doable. Okay, rapid rescore, you can write that down, is a term used to rapidly rescore your credit report because we can. If you've got a collection from 3 years ago, no. If you've got a credit card balance that's high and you have the ability to pay it lower, and as a result, it'll increase the score, yes. As an example, that's a rapid rescore. Mortgage program options, conventional loans, we talked about that. Conventional can go as little as 3% down. It's a high rate. Conventional FHA, the difference is mortgage insurance falls off on conventional at a certain point. This isn't really that important at this stage. What's really important at this stage is understanding what your budget is, how much cash you have to close, do you like the house, and then we can play with the benefits later. Again, and I'm just respecting time. I want to get through the other stuff I also feel is valuable. FHA 3.5% can go down to 580 and even lower. But again, if someone's in the 500s, it's because most likely they're unaware as to why it's that low. They just know it's low and there's some collections. So what do? Well, as an example, you talk to me and I'll say, all right, do X, Y, and Z and go do it. And then if you do it, you'll see an improvement. I get business a year later all the time because someone took my suggestions and they came back and said it worked, I'm ready to go, and then they go. VA loans, we talked about that, zero money down. Refinance programs, we talked about all of that. Self-employed, anyone you know, self-employed, no tax returns. We use bank statements, 1099s, asset depletion, asset-based. Based on what everyone has shared, that's not really important, but I'm letting you know that if you know someone who's self-employed, you just have to let them know that there are options. Banks, brick and mortar banks, don't have these products. They have these products. But someone like me has these products where the bank says, no, I can help them. Real estate investors and the real estate. If you ever think about getting into real estate investing, you don't need any income. It's awesome. You need zero income. The DSCR loan is based off of expected rental income. What potentially the property is going to bring in an investment income. That's how that qualifies. So we were talking before about doing a duplex or a tri or a 4-unit. So some people who maybe want to buy something and maybe the budget is a little on the lower side, a duplex, a triplex, or a 4-unit, you can buy FHA or any of these products, and then you can put and we're able to use the income of what the other units are producing or what they will produce to get you qualified. And that's what investors use, even if they're buying it as investment property, the same product. Okay. Understanding refinancing, we could probably skip through that, right? I'll just quickly kind of go over it. And all of this goes into one. And by the way, and I see a couple of you guys taking pictures. Send me an email. I'll send you this whole PowerPoint. Okay. So because there's some really good stuff on here, I believe, and then it'll kind of help get some things going. And then hey, I have a question about this, Jay, this bullet point, and then we talk about it. Understanding refinancing, it just goes back to what is your intention and does it make mathematical sense, yes or no? The home buying process. So it starts with a pre-approval, and then it moves to the home search, and then enters the contract, and then inspection, appraisal, and title before arriving at closing day. I've got a video, I put a master class on YouTube, and if you send me an email, I can send you the link. It's over an hour long of the process from start to finish if you want to deep dive, okay? But essentially, we talk first, what's your budget? What's your cash? Where's it coming from? Let's set up all the numbers first. Then you're pre-approved. Then you go shopping. You find something that matches. We talk about the numbers. Hey, Jay, this is what I'm pre-approved for. Do these numbers work? The taxes are X. The HOA is this. Whatever. Does this work? Yeah, it works. Okay, contract. Then contract comes in. We've already looked at all of your W-2s and pay stubs and all that in the pre-approval process. And then 30 to 45 days later, the keys are in your hands. And typically what I do is you just have to respond to me or my team. Hey, we need an updated copy of your bank statement or a pay stub or a copy of your driver's license, just miscellaneous stuff. You just respond. But before you know it, you're pre-approved, you go shopping, you pick something out, and literally 30 to 45 days later, it's awesome. You hear the keys hit your palm, and you literally go walk in your new house. It's a really cool feeling if you haven't done it before. Even if you have done it before, it's still a cool thing to do it when you do it, because it's like you just went through this journey of all this thinking and all the work, and it's like, okay, it's done. Now I need to go paint the walls, right? Okay, for homeowners selling and buying simultaneously, understanding how to coordinate your timeline. So I've done this plenty of times in my career. Someone buys a house and they're selling their house, and it can be done on the same day. Meaning you have a buyer, well, you're going to buy your house, you decide 2 years later you want to sell it, but you also want to buy this house with the money, and it can happen on the same day. That requires strategy, but just put that on the back burner. An appraisal protects both buyer and lender by confirming the home's value. Okay, So you go under contract for $200,000, right? And now you have to assume that the appraisal is going to come in at $200,000. The appraisal is a piece of paper that someone goes out and says, okay, this is worth $200,000, and then you're good. You know you got a fair deal. The seller sold it fair, you bought it fair. It's $200,000. If it comes in less than that, now we have an obstacle. Because you're buying a $200,000 house and the value came in at $190,000, what happens then? The seller has to drop the price. The seller might say, I'm not going to drop the price. You have to pay the difference out of your pocket. Well, you don't have the money to pay out of your pocket. Okay, well, then you meet in the middle. You still don't have the money to do that, to meet in the middle. All right, well, then the deal's dead. And that's not the right house for you. Okay? So if the appraisal comes in lower than the contract price, that's what can happen. And also, a little side note, I'm recording this, and I'm going to put this in a format. So when you ask me for the PowerPoint, by then, hopefully I'll have all of this video so you can go back and watch it again. Okay, so you can kind of take your time with it. From accepted offer to keys in hands is typically 30 to 45 days, and understanding what happens at each stage reduces the stress. So it's, again, my intention is to make this very simple for you. If you want to deep dive, I'll send you the link to what I call the masterclass. It's the whole process from the very first conversation to the keys in your hand, and we are funded. And then you're off into your new home. Okay, pre-approval process. It gives you a real number. And again, there's two numbers. One number is what you qualify for. The other number is what your budget is. Okay? We want to go with what your budget is. I'm not really too concerned what you qualify for. We want to make sure what you qualify for and your budget match, but your budget is the most important thing. What can you afford and what is your comfort level? Okay? That way you're not guessing. You know what you're getting into. So if your comfort level is $2,000 and the mortgage obligation with tax insurance comes back at $2,500, it's out of budget. That's not the right house for you. Unless you're like, let's squeeze it to $2,500, which some people do. They'll love a house and they'll push, which I'm not a big advocate of, because you want to be able to lay your head down at night and relax, knowing that the payment's covered, right? Or that you're comfortable with it. So we just want to be very aware of that. For homeowners exploring a refinance, the same thing applies. Income, credit, current equity review to determine what programs are right. So we're just going through a strategy before anyone makes a decision. What do you want to do? What's important to you? What's your situation? Let's talk about it. Let's go through it. And then we lay out the strategy. We meaning anyone who's in my position, which they should be doing. I help you lay out a strategy so you say, okay, I feel good about that. Sometimes that means you're doing nothing. You're going to sit and wait. Key documents needed. This is a good one to write down. 2 years of W-2s or tax returns. If you're employed, which I think everyone in here is, W-2s are fine. So we're at 24 and 25. Recent pay stubs, last 30 days of pay stubs. And 2 months of bank statements and a government-issued ID, driver's license, as an example. That's pretty much it when you're trying to get pre-approved. We go through an application, we pull credit, we look at these documents to make sure that your W-2s and pay stubs support what your budget is, and then you're pre-approved. And then you go shopping.
Recent pre-sub is 30 days, right? That's 30 days.
We always want 30 days. When I'm pre-approving you, it's 30 days, but it might be 60 days before you even go under contract. So I'm always going to ask for updated pay stubs. But 30 days of pay stubs is what I need to issue the pre-approval. And by the way, the pre-approval, I get asked this a lot. How long does the pre-approval last? The answer is indefinite. It lasts infinity as long as everything stays the same or improves. And when I issue a pre-approval, I like to customize it. I don't want to just give you a pre-approval and say, go shopping. I say, you are pre-approved. When you have a house and you want to make an offer, let me know. We're going to put in the dollar amount of the offer and the address. That's going to increase your odds of getting your offer accepted. It's customized versus just a general one, a generic one. Debt to income ratio is the number lenders watch most closely. So you hear DTI or debt to income ratio. The debt to income ratio is all of your current debt that's on your credit report plus what your mortgage obligation is going to be. That's your debt. Okay? So if you have $1,000 in credit cards and car payments and your mortgage payment's going to be $2,000, your monthly debt is $3,000, which means you need to be bringing in about $6,000 as an example. Okay? Common mistakes to avoid. Okay, we're doing pretty good here. We're almost finished. Common mistakes to avoid. We talked about this, taking on new debt or making large purchases after pre-approval or during the refinance can change your DTI, right? If you go buy a new car and now we're adding $400 or $500 to your monthly debt, then your loan's going to be lower, and then it may not make sense, or it could hurt the whole deal. So remember, 90 days, don't touch it if you can avoid it. And if you have to, then you just ask me first, this is what I need to do. How is it going to affect me? And then we can brainstorm and figure out what the solution might be. Changing jobs mid-process, even if for more pay. Not saying don't do this, but we definitely need to speak before you make a move and you change jobs. Okay, because that can affect things. Everything's all set up. It adds extra tiers and extra layers, which, I never have a problem going down that path, especially if you go from making 50 or 60,000 a year or 30 or 40,000 a year to doubling your income. Absolutely, right? However, when you're at the new job, we need to show you've been there for 30 days. So that could affect timing, right? Not all the time. That's not a black and white rule, but you can see if you change jobs, it can affect the process. Moving money between accounts with a paper trail without a paper trail creates problems. Every large deposit must be documented and sourced. Very important. If I'm looking at bank statements and I see, and I'm always wanting the last 2 bank statements is what I'm always looking at. If I see a large deposit come in, the underwriter is going to ask, what is that? Okay. If you go to a casino and you play casino and you get $5,000 and you put that in, they're going to say, where'd you get that? Where'd you get the 5,000? If you're using the 5,000 for the buying the house, where did you get that? Well, I wanted it at a casino. That could be a problem because it's cash, and cash can be looked at as money laundering, flat out money laundering. So it needs to be traced. If you win 5,000 at a casino, make sure you have the receipt. If you sell a car for cash, make sure you have the receipt. But anytime money's moving, before you move any money, if you're in the middle of a transaction, call me first. Moving money from savings to checking is moving money. It just creates an extra layer, potentially, of unnecessary items you've got to hunt down. Missing or delaying document requests from your lender is the most common reason closings get pushed back. Respond quickly and keep everything organized. Very important. Just respond. You might not be able to get something right away. Tell whoever's asking you for the item, hey, I've got to get this. It's going to take me 2 days. Fine. But if you're dragging your feet, there's a domino effect. It can hurt things all the way back. So one of the best things you can do as a home buyer or homeowner is respond quickly to what's being asked for. And response sometimes means I'm not going to have it for a day or 2, and that's fine. And you always should be able to get what you need. You just need a little creativity. Maybe you need to download this or speak to this to have them create a letter of explanation. There's always a way to get something quickly. You just have to let the person who's requesting it know that you're running into a bump. That's really important. Okay, last slide. Build long-term wealth through home ownership. The big picture, why owning a home is one of the most powerful financial decisions you will ever make. Every mortgage payment builds equity, a forced savings account that grows through both principal paydown and property appreciation over time. You're going to have a mortgage in the first 5 or 6 years, your mortgage balance is going to be pretty much the same. It's not really going to get paid down. But the home value is going to be going up every year. And so that's equity, the difference between what you owe. You'll start to see a dent in your mortgage balance after years 7, 8, 9, and 10. But there is a 92% chance you're not going to have the same mortgage after 5 years because you'll sell the property, you'll refinance, or whatever the case is. But the focus should be, in my perspective, is the fact that you own the home and the value is going to go up in value. The home's going to go up in value. The long-term wealth gap between renters and homeowners is significant. Homeowners have a median net worth multiple times higher than those who continue renting. If you're renting, the money's gone. You'll never see it again. If you're owning, you're essentially renting, except your home is going up in value, so you're building an asset. And that's one of the benefits of home ownership, especially if you're going to do it again and you rent it out, you go buy another house, you do it again. Now you have 2 homes, etc. Tax advantages, including the mortgage interest deduction, property tax deduction, and capital gains exclusion on the sale of a primary residence. So one of the benefits in owning a home is the interest on your mortgage is tax deductible. So you're making a mortgage payment of $2,000 a month, but the interest is tax deductible. Interest tax deductible just means that your tax refund might be higher at the end of the year because you're a homeowner. So $2,000 a month in rent goes out the door. $2,000 in mortgage obligation, you're going to get some of it back in your tax refunds because the interest is tax deductible. And so is property tax. Capital gains is when you sell your house. If you buy it for $200,000 and you sell it for $250,000, you just made $50,000. $50,000, you have to pay income tax on that. Or you do it strategically and you don't have to pay capital gains taxes. It's just a way to keep on the ultra wealthy understand capital gains taxes. They avoid having to pay the government this high dollar amount, and then they use it for themselves, which is what we all want, right? If we can. Your home is not just a place to live. Managed wisely, it becomes the foundation for your family's financial future, funding retirement, education, and generational wealth. And you can really, really do something good when you're buying real estate. And you just have to feel through it. And you just have to see where you are and what makes the most sense. Thank you. Hey. Okay, so we're going to open it up for some questions. And tell me your name again. I'm sorry. What is it? Akiria. One of the most beautiful words in any language is the correct pronunciation of what they prefer to be called.
And I'm trying to get people to say Akiria.
Akiria. Yeah, she's trying to make. Yeah, that's okay. Well, that's her job is to try to make it. You know how moms are. Okay, Akiria. What's your question?
My question is, so if you use one of the assistance programs to buy a home, could you like sell it too, or could you?
Yes,
like
yeah, absolutely. So, and real quick, because I know some of you are going to get ready to head out, I want you to write down my number so you have it. And this is my cell phone, so you can text me. And if you have a question outside of this, maybe it's because it's personal or something pops up, I want you to feel comfortable with being able to call me. Okay, and my number is 954-612-8192. And you also have your form in front of you that if you want to fill that out and I can review it and look at it and call you as a result, then I'm happy to do that as well. Okay? Okay, gotcha. Yeah, I'll take that right now. Okay, so let me answer the question first. The question is, if you use DPA, can you sell it? Yes. The DPA wants to get paid back. The only difference with DPA products is one is a grant where you don't have to include it in your monthly payments. And another DPA product is it's a loan. They're charging you for that loan in your mortgage payment, so your payment's going to be higher.
Well, I phrased it wrong. I meant to say if like I was to use the assistance program and live there, and after like 5 years, I want it to be like a rental space. Oh, what happens? Oh, great question. Nothing. You let it ride. Yeah. Because at that point, all the DPA really cares about, essentially, and things might change, but that payment's being made, right? And if the house sells, they're like, hey, listen, if it sells, you got to pay us back. But if you're not selling it, then you're good. That's what some restriction I have to live in. Correct. There, in my understanding, most DPA, because there's lots of different DPA programs out there. Most DPA programs allow you to utilize it to get in, and as long as the payment's made, you can go. But it's a great question to ask before we take advantage of the DPA is, what is the restriction for this particular DPA product? Is there one? It's a good question. I think you had a question, then I'll get to you. Did you have a question?
Can you comment on those, like, it's called mobile park?
What is it?
The mobile park, it's
mobile home?
Mobile home, yeah.
Like mobile home. Yeah. Okay.
It seems like
yeah, no, mobile homes are fine.
Hurricane and there's some.
Yeah, no, you can do FHA, all these different products. You can do FHA, conventional on mobile, manufactured home. That's a really cost-effective way to buy a home. The age of it is very important. If it's before 1975, it's a dead deal. Most lenders in this environment who are going to lend on manufactured homes, they want it to be less than 10 years. So what you can do is you can literally buy a piece of land and buy a manufactured home in the same transaction. And that's a cost-effective way to get a brand new home.
But doesn't it have to be within a certain area of a city? You can't just put it anywhere.
That's up to the city, I guess. Yeah, but that is a good question. But the city will determine if you can. You just got to say, hey, I want to maybe even chat or Google. It's hey, are there any city restrictions like in Boynton Beach? I'm sure east of 95 has a different restriction than out of 441, right? Yeah, but it's a good question.
Age for the mobile home.
Yeah, age, meaning that if the mobile home was built 20 years ago, it's going to be a problem because it's an old built mobile home. Age of the construction of the manufactured home becomes important when getting a loan for a manufactured home. When was it built? Yeah.
Could you use maybe a DPA to purchase land and then also buy a manufactured home?
No.
It's just for the home itself.
The DPA program, well, let me back up. In theory, and this is not easy to do, but it's doable, you can use the DPA to buy the land and the mobile home in the same transaction, but buying a piece of land by itself usually requires 30 to 40% down. If you're going to buy a piece of land and not do something right away, it's typically 30 to 40% down of the purchase price.
Got it.
Yeah.
Going back to moving money.
Yeah.
What if you're one of those individuals that don't really save your money in a bank?
Yeah. So if you don't, which is a good question because I work with a lot of folks that do that. So some people have a shoebox, right? And that's okay. However, we can't use that money unless it's deposited in a bank account. And then I ask for 2 months of bank statements and I don't see the deposit because you deposited in March and here it is June. And I say, give me your last 2 months and you give me April and May. So you deposited in March, you send me April and May, there wasn't a deposit showing. And so you're good. So the answer to the question is if you're going to use cash, get it in a bank account and then wait 3 months before you can use it. Okay. Or someone gives a gift and then you give them the cash. Is another way of doing that.
Share with us where you based in? Are you based in
Here. Yeah. Well, my sons and their mother live up this road right here.
Oh, okay.
And I'm in Lake Worth. Yeah. And I'm over here a couple times a week. Just for the record, my sons and their mother, we're in the best relationship we've been in its entirety. And by the way, the Koa River Group, Koa and River are the names of my 4-year-old and 6-year-old sons. That's where Koa River comes into play. And that's a Koa tree. And then there's a river, and that's where the logo comes from. Yeah. Yeah. But I make most of my business, probably 75% of my business is South Florida, Tri-County. Another 15 is throughout the state of Florida. And then I do business pretty much in every state in the U.S. So if any of you have relatives outside of Florida, I can do a loan for them.
So you're more of a consultant rather than like a realtor?
Well, a realtor is someone who's going to take you to show a house. My job is to get you money to buy the house. And then the company I hang my license with pays me a percentage of the loan to do all this stuff that I'm doing with you now. That's how I make a living. I make your life easy in doing a mortgage, getting you the money so you can buy the house. And then my company pays me a percentage of that.
So you're a shop for lenders?
Well, I'm a lender and a broker, but yes. Yeah, I am the finance guy. I'm the guy that gets you the money so you can buy the house or refinance. Yeah. And then I work with realtors who I can set you up with, who would then take you shopping to go find the house that you want to buy. And then you come back to me and I get you the money so you can buy the house. Yes.
With manufactured homes, is it different than a regular home as far as building equity?
The question is, in buying a manufactured home, is it different in building equity than if it's not a manufactured home? That just depends on the market and the supply and demand. If you go buy a piece of land and you build a manufactured home in Ocala, right, or out in Okeechobee, that's going to be different than if you do it on US 1 in Boynton Beach, right? A mobile home in US 1 in Boynton Beach is going to go higher in value than a single family home out in Okeechobee, as an example. Okeechobee Lake, because Okeechobee is actually doing very well right now out in Royal Palm Beach and that sort of thing. So the answer just depends on the market. Here's what I suggest when you're buying a home is, I've been talking about wealth creation, but when you're buying a home, if you're buying it as an investment property and you're going to live in it first, great, right? You have a plan. In a few years, you'll see what happens and then you rent it out, right? But what I'm encouraging when you're buying your first home or you're moving into a home is you move into it because you want home ownership. It's a lifestyle choice and you're comfortable with the affordability, and leave the investment side alone. You can have the vision of eventually I'm going to turn this into a rental, but I wouldn't buy your first house with the intention of making a lot of money. Now, if you want to buy an investment property with the intention of making money, then that becomes a different conversation. But that's what I encourage is buying a primary house is a lifestyle choice with the possibility that it's going to turn into something that's going to benefit you for your wealth. And when I say wealth, wealth is relative. People make $1 million a year and their bills are $2 million a year, right? They're not wealthy, right? Someone makes $50,000 a year, their bills are $20,000 a year, and they're putting aside $40,000 a year, and they got plenty of cash in the bank. To me, that's wealthy, right? Wealth is being able to do what you want when you want to do it, and there's no number for that, right? But using real estate can help you get to the lifestyle that you want. Yes.
What would you recommend for married people buying a home? Like, would you just have one person on the deed or the loan so that the other person can get a separate property?
Gotcha. Question is, if you're married, can one person go on the deed, and what do I recommend? Well, in Florida, if you're married and you're buying a primary house, you both have to go on the deed. That's the law. If you're buying an investment property, it's something different. So you're both, in fact, going to go on the deed. You're both, in fact, going to have responsibility financially. And so then it becomes who's going to go on the mortgage, right? If I only need one of you to qualify for the mortgage you want, we would only use that person based on credit score. Typically for a couple, it's we need both incomes, right? And if we're using both incomes to qualify for the mortgage, great. However, we have to use the interest rate is based on whoever's credit score is lower of the two. Okay? So a married couple, likely that both of you are going to go on the mortgage. They're both going to be on the deed. You both own it. Most likely you're both going to go on the mortgage, and the interest rate is going to be based off of whose credit score is lower. Okay? And if, like I'm dealing with a couple right now where the wife's credit score is fine, the husband's credit score is really bad, and we don't need the husband's income to do what they want to need to do. So we're only doing a refinance. We're only using her, and it's working.
So what's the likelihood of I know lenders, they probably look more closely at couples versus single people. So what's the likelihood of getting a loan based on being single?
Very high.
Really?
Yeah, because I don't care about it. Well, I'm going to speak for myself. Couple, singles, it doesn't matter. What matters is dice. We talked about dice. What's the debt? What's the income? What's the credit? What's the equity? Okay, that's the bottom line. I'm working on a loan right now where it's a very wealthy family, and the son is like one of those. Okay, the son is he's never done anything like this before, and he's just been coddled his whole life. And dad's like, he needs to do this on his own, right? And so, and it's just it's a really interesting dynamic. And so dad is willing to help, but he's by himself, And so it's like, well, what does he need to do to make it by himself? His income is supporting a specific loan amount, which means that he needs to put down more cash. But that's just what it is. So I go back to the simplicity of DICE. As a mortgage lender who is going to essentially say, this is what you can and can't do, I'm focusing on DICE. What is the debt? What's the income? What's the credit? What's the equity position? I don't care if you're single or a couple. What I do care about is how can I serve you and how can I make this feel good for you? And we'll move forward and create a strategy.
If someone co-signs for you, does it affect them being a new homeowner too?
Great question. If someone co-signs, does it affect them being a new homeowner? Yeah, because when they're co-signing, they're taking on the debt and the responsibility as well. It's called a non-occupant co-borrower. By the way, this is a really good thing that you brought up. If let's say you have this idea of your budget and your income doesn't support it, that's why you bring on a co-signer. It's called a non-occupant co-signer. They don't have to live in the house. They can live in a different state. Why are we adding them? We're adding them because we're using their income to help qualify for the mortgage. Okay? As soon as they sign up, then they're now responsible for that debt. Okay? But it's only for 12 months. Yeah. So what happens is after 12 months, you are going to send me, let's say let's say I'm going to use you two as an example. Okay. You co-sign and then you're making the payment. And 12 months later, you want to come buy a house. And I say, oh, I see you have a mortgage here. No, that's my daughter's, right? She's paying it. Okay, send me evidence that you've made the payment for at least 12 months. And then it's negated from your responsibility.
Well, let me give you this scenario. I have a home in Georgia.
Okay.
Which I only purchased a home for my other daughter who's going to school there.
Okay.
She's really the owner in name only.
Okay.
But I co-sign.
Okay.
I pay the bill. I run it as an investment.
Okay. How do we negate that payment? Yeah, she has to start making the payment out of her personal bank account.
No,
unless
I own it.
Okay.
I run it as a,
Okay, then it's a rental.
It's a rental.
Okay, so but she's your daughter who's renting it.
No, no, she's not renting it.
Right. So it's right. You bought it as an investment property. I mean, it's looked at as an investment property because you don't live there, but your daughter essentially lives there.
She
went there to be a resident of Georgia.
Right.
So that's why she purchased the home.
Okay. So who lives in the home right now?
No, it's being rented out.
Airbnb rentals.
Oh, then you're good. Yeah, that's an investment property. Yeah, with that, it would be show me 12 months of Airbnb income, roughly. And I even have a product where that's considered investment property. You're fine. There's definitely a way around that. That's something completely separate. So I can make that work.
Can you say that a cosign?
Yeah, cosigner. Yeah, cosigner is it's like someone's cosigning for a car loan.
I know it's cosign, but you have a
non-occupant. Non-occupant, meaning that the cosigner doesn't need to live there. They're not occupying the property.
You said after 12 months, I could have come out of the mortgage.
Not come off the mortgage. It's if you go to buy something and it shows up on your credit report, which it will because you co-signed, and I say, what's this mortgage? And you say, well, it's my daughter's mortgage. I say, okay, we can remove this as debt for your new house as long as I have 12 months of evidence that she's been paying it.
And when you say evidence showing that it's coming out of my account,
correct.
There's no help.
Correct. If you guys are on a mutual bank account, that's a problem. So as long as you're making the payment, then, and again, you're still on the mortgage and you're still liable, and we want to make sure she's making it so it doesn't affect your credit. But I'm talking about debt to income ratio, the D in DICE, that we need to make sure your debt to income ratio is low. So we've got your investment property in Georgia that we can play with, and we've got 12 months of evidence that was paid. And so you then can go in pretty much, we got to do a little bit of massaging, but negating these other liabilities which we want to keep your debt to income ratio as low as possible. And we can do that.
For her to be able to purchase one.
Correct. Investment property and co-signing 12 months evidence, you should be in good shape. And I'm just answering your question just based off of this. I want to deep dive a little bit more, but that gives you conceptually how that would work. Yeah.
The key documents needed, if I retired already, so does it mean I don't need to provide the 2 years of W-2?
You would just give me a social. You would show me evidence of how you're bringing in income, which would be a Social Security awards letter or a pension awards letter, right? So I need to see that every 30 days. How are you making money? And then I need evidence of that.
The money is in my bank account.
Well, that's an asset. So if money is in your bank account, that's an asset. I'm talking about income. So if you've got $1 million in your bank account, for example, and you're not bringing in income, it's a different conversation. So the question then becomes, every 30 days, is money coming into your bank account? That is income.
If there's no income?
If there's no income, then one of the products is the asset depletion product, because now we're not using income, we're using asset, which is, okay, you've got $1 million in the bank, I can actually give you a mortgage, which is a fairly new product. I can give you a mortgage against how much money is in your bank account versus income.
Okay.
Yeah. Any other questions? All right. Well, so I'll leave you with this. As I mentioned, you've got the forms. If you want to call from me, then just fill out your contact information, at least on the form. You have my contact information if you want to call me direct. And I hope that this has brought you all some value today.
So you have an office?
Thank you. Yes. Yes and no. My office is Delray. But what I do, I work out of my home office mainly, and I do Zoom calls for face-to-face. But usually the face-to-face and Zoom calls are just to feel each other's energy, right? And so we can do that, or just hop on a call, and you essentially just say, here's what I want to do, and here's our situation, and then we just kind of get into it, and I'll help you create a strategy.
Okay. So how long would it take to get a pre-approval, or it just depends?
The answer is it depends. I mean, if someone gets their ducks in a row, you fill out an application online, for example. I'll send you a link and a list of documents, what you saw, but I just send you an email. And then usually within 48 hours of you doing your part, which is getting me the documents and filling out the application, I can let you know what it looks like. 48 hours. So it's quick. If I have you, are you renting right now?
We live with family.
Okay. Oh, so you live with family. So you're like free to go, essentially. So in theory, you can get pre-approved in 48 hours, go shopping, find something on the weekend, and close 45 days later. That's how quick it can be. Now, if we're adding the DPA, it creates extra layers. I'll be very upfront with you. I don't like using the DPA because it's a pain. There's red tape. When you're bringing in more humans into the equation, it just creates stuff, right? So if you can utilize the other ways we talked about coming up with the money, whether it's cash in the bank or all the different ways, that's going to give you your smoothest transaction, your smoothest path to closing. But I can let you know all of that when I speak to you.
Yes. Okay. So, what are your business hours?
Pretty much before the sun goes down, and Monday through Friday. Yeah. So, but you can, just text me what I like to do. I actually have a Calendly link that I can send you. Yeah. If you have your information? Yeah, you can just shoot me a text, and then we'll set up a time where it's convenient for both of you. We'll allocate some time, and we'll go through a strategy. I'll answer all your questions for you, custom to you, and we'll get things going. Yeah. And if you need to speak to me like after business hours and we need to customize it because you guys work or something like that, and we just need to do that, then I'll make that work for you. Yeah.
Thank you. Nice
Absolutely.
meeting
You're
you.
welcome. Nice meeting you too. Thank you for coming.
Can I ask one more question, sir?
Yeah, no, take your time.
Is it,
Oh, actually, go ahead.
I saw something that's for first home buyer. It's a nurse. Is it easier to have a loan?
Well, it depends on your income. It depends on your income. Like if as a nurse, like I actually have a product for the medical community, for nurses. That's an income-driven product. Is it easy? It's in my experience of doing this close to 27 years, very few are easy, right? But the more efficient you are, the more organized you are, the easier it becomes.
So does it mean I have to be a registered nurse for 1 year before?
I would say for you and I to have a conversation. So you let me know, what is your situation now? What are you wanting to do? And then I'll be able to give you a custom strategy. Yeah. Yeah.
I don't have on my glasses.
Oh, that's
but
okay.
This is my cell number. So can you?
Yeah.
Can you understand it?
I do.
561-523-1908.
I do. I can see that. Yep.
If you could text me
Okay.
before calling, because I normally don't.
Okay.
I know the number. I
Yeah.
recognize the number. I won't answer.
Yeah.
So and we can talk.
Yeah.
Okay, I'll call you back.
I'll say I'm the guy that